For investors in today's environment, if they're focused on allocating capital to developed markets, really you can look at North America versus the UK, Europe. We all know the challenges in the UK and Europe, Brexit, German elections in about a year's time. You've got elections going on in France in the spring, and then you've got a referendum in Italy. So lots of headwinds there. North America, on the other hand, we think is better positioned because a lot of the uncertainty around the US election is now behind us. Canada, in fact, we believe is now turning up, had a pretty difficult couple of years, but now looking a little better with oil prices bottoming early this year and now in a much more stable range. GDP is looking better, and with the US election having completed and the Republicans now controlling Congress and the executive branch, we think you're going to see a lot more business-friendly policies, less regulation, lower taxes, all of which we think causes the North American economy to look very attractive relative to other developed markets, as I say, like the UK and Europe. So I think it'll actually be very positive over time. As I mentioned earlier, the Republican pro-business policies, I think, will be positive for economic growth in Canada. Recognize that Canada does 80% of its trade with the US. So if the US is actually doing better, Canada will do better. There have been some concerns around free trade agreements. So now we're into our 22nd or 23rd year of NAFTA. So this is the tri-party trade agreement between the US, Mexico, and Canada. And there's been a lot of talk around renegotiating NAFTA and what impact that'll have on Canada. We believe the impact on Canada will be very, very modest, if any, because when you think about what NAFTA has done, it's really moved a lot of manufacturing jobs into Mexico. On a per capita basis, Canada's actually lost more manufacturing jobs than the US has. So when the new President-elect Donald Trump talks about bringing jobs back to the US, they're really coming from Mexico, not from Canada. So overall, we don't think there's going to be any negative impact there. And as I mentioned earlier, we think with greater economic growth in the US and the two economies, Canada and the US, being so closely aligned, we think there's going to be real positive benefit to the Canadian economy as well.
Yes, well, as the name of the portfolio says, it is a Canadian-focused fund. Typically, we've been about 80% Canada, 20% US over the last few years. We have a minimum of 60% Canada, maximum of 100. Typically, we would use a sleeve of US just to give proper diversification for the fund. In Canada, we don't have a strong healthcare, technology, even consumer names aren't prevalent in Canada. So that's where we would go to the US to get access to those industries. And in addition, if we want access to the US consumer, we can buy the US banks or US credit cards. Well, from a growth perspective, I think three sectors stand out. One would be pipelines in Canada. They're growing at about 5 to 10% organic growth rate, probably over the next 5 years, as infrastructure projects and energy pipelines are being built across the country. Another sector would be the healthcare sector. The tailwinds that we're getting from a demographic standpoint over the next 10 years really benefits the pharmaceutical companies in the US, and we are allocating more money to that side of things. The third, and this would be a more recent trend given what's happened with interest rates, the financials are looking more attractive. Yield spreads have moved up, and that allows the financials to finally make a pretty strong net interest margin. So the financials and the growth expectations are starting to increase in that side of things. From a valuation standpoint, the sector that looks very good value currently are the REITs in Canada. Due to the sell-off in bond proxies and interest sensitives, REITs have sold off about 10% in the last week or so. From a valuation standpoint, they're trading at about a 10 to 15% discount to net asset value. That's always been a great entry point. In addition, from a cash flow spread, they're essentially trading at the cheapest values we've seen versus US REITs and versus the financial banks since the crisis in 2008, 2009. So the REITs look like great value currently.
Well, again, this is a uniquely Canadian vehicle. So when you look at the investment trust landscape in Canada and the UK, where the vast majority of our investors are, if you have the view that we have, that the Canadian economic backdrop is strong and improving, that the U.S. economy is improving, you've got a strong North American base against which we're making our investments. So you could look at some alternative products here in the UK that would be deemed North American. However, the vast majority of those, if not all of them, would have very little Canadian exposure. Ours is unique in that, as Rob mentioned earlier on, we're always going to have a minimum of 60% Canadian content, and the vast majority of times will be between 70 and 80%. So if you have the view that we have, the Canadian economy is actually well positioned, that energy prices have bottomed, that trade with the US will actually grow over time, then a lot of these Canadian companies will do quite well. This is the great way to play it. Over and above that, you've got the fund that trades at a modest discount to NAV. So here you are, you can buy something with some growth, provides an attractive yield of about 5p, and actually you can buy it at less than what it's worth, its net asset value. So the fund has been paying a 5p dividend since early 2011, and it's been well maintained. And the way we look at the portfolio construction for Middlefield Canadian is really looking at, number one, stocks that pay a dividend, number two, stocks that have a history of growing dividends. And over time, on a total return basis, i.e. dividend plus your growth, we've actually generated some positive returns, i.e. you've been able to pay the 5p dividend plus some capital growth over time. Having said that, from time to time, the board is always reviewing the current situation within the fund, where the net asset value is, where the income generating is, and what are the prospects for dividend increases within the portfolio itself. So we can make a case today that over time, if oil prices do what we think they can, i.e. trade within that $45 to $60 range over the next few years, you could see some dividend increases out of your energy portion of the portfolio. The financials, which represent somewhere around 15 or 16% of the fund today, given the increasing interest rate environment we're currently experiencing, you're going to see greater margin expansion within the financials. That may manifest itself in the form of greater dividends, especially if the U.S. portion of the financial sector is going to be deregulated. There may be more capital available for dividend increases. So we can make a case here over time that the dividend income into the portfolio will actually grow, and that may translate into an increase in dividends over time. And as I say, the board's reviewing that. We're not in a position to make any decision on that at this point. However, it's looking positive.